Midland Wealth Management presents Market Insights.
Welcome to the monthly market update from Midland Wealth Management. I'm Chris Zabel, Portfolio Manager. Today I wanted to take a few minutes to give you an update on the markets for the month of January. The stock market started the year off relatively strong, with the S&P 500 gaining 2.8% in January. The S&P 500 was bolstered by relatively strong earnings and consumer spending, despite a sharp sell-off after a new AI model from China shocked investors. Mid and small cap stocks outperformed large caps, with S&P Mid Cap 400 up 3.9% and S&P Small Cap 600 up 2.9%. Corporate earnings releases for the fourth quarter of 2024 kicked off in January, with about 36% of companies in the S&P 500 reporting. Earnings grew by 7.8% and sales grew by 4.5%. The Magnificent Seven so far have had good earnings, but AI expectations have underwhelmed investors. Stock valuations remain high, with the S&P 500's forward price-to-earnings ratio at 25.7. Analysts are still projecting earnings to grow by 14.3% in 2025. The first estimates for annualized fourth quarter GDP came in at 2.3%, lower than third quarter's 3.1% and slightly below expectations of 2.6%. Growth was driven by consumer spending, but change in private inventories negatively contributed, as companies may have not front-loaded inventories ahead of any potential tariffs. Expectations are for GDP growth to slow in 2025. The U.S. labor market continued to show resilience, with the economy adding 256,000 jobs in December, surpassing economic projections of 164,000. The unemployment rate edged lower to 4.1%. from 4.2%. January is expected to see a slowdown in jobs growth, with the economy adding 170,000 jobs and unemployment remaining at 4.1%. On January 29th, the Federal Reserve held the federal funds target rate at a range of 4.25 to 4.5%. The Fed will continue to assess incoming data and an economic outlook when considering additional adjustments to the target range of the federal funds rate. Expectations are for 1 to 2 additional rate cuts due to ongoing concerns for persistent inflation. The 10-year U.S. Treasury yield fell in the second half of January to 4.54% as there was a flight to safety during the most recent market volatility. Looking ahead, investors will remain attentive to labor market data, Federal Reserve policy shifts, fourth quarter corporate earnings, and what impact the recently announced tariffs will have on the economy and inflation. Thanks for joining me for this month's market update.